Imagine waking up tomorrow morning and discovering that almost every dollar you save for retirement, every ETF you buy, every pension fund you rely on, and thousands of the world's biggest companies are connected by one name. A name you've probably heard before, but never really noticed. BlackRock. You've never walked into one of its stores. You've never downloaded one of its apps. You've probably never even considered becoming one of its customers. And yet, every time you buy an iPhone, watch Netflix, use Microsoft Office, drive a car, fill up your gas tank, or simply invest in a retirement fund, there's a chance BlackRock is somewhere in the background, not because it owns those companies, at least not in the way most people think. Over the last 3 decades, this quiet Wall Street firm has become the largest asset manager in human history. It advises governments during financial crises. Its software helps major banks manage risk. Its shareholders' votes influence thousands of public companies. And today, it sits at the center of a financial network worth more than $14 trillion under management. Naturally, that has made BlackRock the perfect villain. Some people believe it secretly controls the global economy. Others think it's nothing more than another investment company. The truth is much more interesting than either story, because BlackRock didn't become powerful by taking over the world. The world handed it influence. One investment, one crisis, and one decision at a time. This is the story of how a company that sells almost nothing ended up becoming one of the most powerful institutions on Earth. If you ask 10 people what BlackRock actually does, you'll probably get 10 different answers. Some believe it's secretly buying the world. Others think it's just another Wall Street bank. Neither answer is correct, because BlackRock isn't a bank. It doesn't manufacture products. It doesn't sell iPhones. It doesn't drill for oil. It doesn't build cars. In fact, BlackRock barely sells anything at all. Its real business is much less visible. People, mostly pension funds, insurance companies, governments, corporations, and millions of ordinary investors hand BlackRock their money and ask one simple question: can you grow this without blowing it up? That's it. BlackRock's job isn't to become rich with its own money. It's to manage other people's money. A lot of other people's money. Today, BlackRock manages more assets than any investment firm in history. Trillions of dollars belonging to teachers, firefighters, pension funds, sovereign wealth funds, and millions of people simply saving for retirement. And that's where the confusion begins, because when BlackRock invests that money, it buys shares. Tiny pieces of thousands of companies: Apple, Microsoft, Amazon, Coca-Cola, Visa, ExxonMobil, Johnson & Johnson. The list goes on, which is why so many people look at BlackRock's portfolio and conclude, wait, they own everything. But that's not quite true. BlackRock usually doesn't own those companies in the traditional sense. Its clients do. BlackRock is simply the manager making investment decisions on their behalf. It sounds like a small distinction. But that distinction changes everything, because if BlackRock doesn't actually own most of this money, how did it become one of the most powerful companies on Earth? The answer starts with a spectacular failure. Before BlackRock became a financial giant, it was just 8 people. No trillion-dollar empire, no influence in Washington, no mysterious algorithms. Just a handful of finance professionals led by one man, Larry Fink. Ironically, BlackRock exists because Larry Fink made one of the biggest mistakes of his career. In the mid-1980s, while working at First Boston, he became one of Wall Street's rising stars. He helped pioneer the market for mortgage-backed securities. His bets generated enormous profits. Until one day, they didn't. A bad interest rate prediction reportedly cost his firm around $100 million. For most careers, that would have been the end. For Larry Fink, it became an obsession. He realized something that much of Wall Street hadn't. The biggest danger wasn't making risky investments. It was not understanding the risks you were already taking. That lesson would become the DNA of BlackRock. When he co-founded the company in 1988, the mission wasn't to chase the highest returns. It was to understand risk better than anyone else. While other firms focused on making money, BlackRock focused on avoiding catastrophic mistakes. At first, that didn't sound very exciting, but history has a habit of rewarding the people who prepare for disasters, long before everyone else sees them coming. And over the next few decades, that obsession with risk would quietly turn a small Wall Street startup into the company trusted with more money than anyone in history. If BlackRock's business is managing risk, then its greatest asset isn't money, it's information. Lots of it. Because here's something most people don't know. BlackRock doesn't rely solely on analysts reading reports and watching CNBC all day. For decades, it has relied on something far more powerful, a system called Aladdin. Despite the name, it isn't magic, and it certainly isn't a secret AI that's controlling the stock market. Aladdin is a risk management platform. Think of it as the financial world's equivalent of an air traffic control system. Every second, it monitors portfolios, measures exposure, runs stress tests, calculates what could happen if interest rates rise, if oil prices collapse, if a government defaults, or if an entire financial market suddenly freezes. But here's what makes Aladdin different. BlackRock doesn't just use it for itself. Some of the world's biggest banks, insurance companies, pension funds, asset managers, even central financial institutions use the exact same platform to understand their own portfolios. In other words, a surprisingly large part of global finance is looking at risk through the same window. Now, that doesn't mean Aladdin tells everyone what to buy. Humans still make the decisions. But if thousands of institutions rely on the same models, the same assumptions, and often the same warnings, that creates something incredibly valuable. Information. Not because BlackRock knows the future, but because it sees an enormous portion of the financial system at the same time. And that advantage would become priceless. Because only a few years later, the entire financial system would begin collapsing. September 2008. Lehman Brothers collapses. Credit markets freeze. Banks stop trusting other banks. Nobody knows who is holding the toxic mortgage securities or how much they're actually worth. Imagine trying to stop a fire without knowing which buildings are already burning. That was the situation facing the US government. They knew the financial system was sick. They just couldn't see where the disease had spread. BlackRock could, not because it had predicted every detail of the crisis, but because for nearly 20 years, it had been building tools designed to map financial risk. While everyone else was trying to figure out what they owned, BlackRock already had systems capable of analyzing complex portfolios in extraordinary detail. So something unprecedented happened. Instead of relying only on public institutions, the US government turned to a private company. BlackRock received mandates to analyze and help manage hundreds of billions of dollars of toxic assets from failed financial institutions. Think about that for a second. The company that had spent 20 years obsessing over financial risk was suddenly asked to help clean up the biggest financial disaster since the Great Depression. And BlackRock delivered. Not by saving every bank, that was impossible, but by becoming the firm governments trusted when nobody else seemed to understand the maze of toxic assets. That moment changed everything, because after 2008, BlackRock was no longer just another asset manager. It had become the company governments called when the financial system itself was in danger. And once you've earned that level of trust, influence tends to follow. If 2008 made BlackRock trusted, the next decade made it enormous, not because it invented a revolutionary technology, but because millions of ordinary people quietly changed the way they invested. For decades, investing usually meant trying to beat the market, picking the right stocks, finding the next Apple, the next Amazon, the next big winner. Most people failed, so a different idea became increasingly popular. Instead of trying to beat the market, why not simply own the market? That's exactly what an ETF does. Imagine you want to invest in the 500 biggest companies in America. You could spend weeks buying every single stock yourself. Or you could buy one ETF and instantly own a tiny piece of all of them. Simple, cheap, diversified. For millions of investors, it was a no-brainer. And BlackRock happened to own one of the biggest ETF businesses in the world, iShares. As money poured into ETFs, BlackRock wasn't choosing to buy Apple, Microsoft, Nvidia, or Amazon because it loved those companies. It was buying them because its clients were buying ETFs that tracked the market. The more people invested, the more shares BlackRock had to purchase on their behalf. Year after year, billions became trillions. And suddenly, BlackRock appeared on the shareholder register of almost every major public company on Earth. That's where the myths exploded. People looked at those shareholder lists and concluded, BlackRock owns everything. Not exactly. Remember, it's still managing its clients' money, not its own. But there is one important detail. When millions of investors delegate their investments to BlackRock, they also delegate something else, their voting rights. And that's where managing money starts becoming influence. Imagine owning one share of Apple. You could attend the annual shareholder meeting, vote on directors, vote on executive pay, vote on major corporate decisions. Now imagine millions of investors. None of them has the time or the interest to vote thousands of times every year. So they let BlackRock do it. One investor doesn't matter. 10 million investors do. That's why BlackRock regularly votes on behalf of enormous numbers of shareholders across thousands of companies. Now, let's be careful here. This doesn't mean BlackRock can simply order Apple or Microsoft or Coca-Cola to do whatever it wants. Its ownership stakes are usually relatively small, often well below a controlling interest. But influence isn't always about control. Sometimes, it's about having a seat at the table. When you're one of the largest shareholders, companies tend to listen, and governments do too. After proving itself during the financial crisis, BlackRock was increasingly asked to advise central banks, regulators, and governments on financial issues. That relationship sparked endless debates. Supporters argued that governments were simply hiring the best experts available. Critics worried that a private company had become far too close to public institutions. Neither side fully tells the story. Because BlackRock didn't become influential through a secret conspiracy. It became influential because, over decades, more investors trusted it. More institutions relied on its technology. More governments sought its expertise. And every crisis made that network even stronger. Which brings us to the biggest question of all. Is that concentration of influence actually dangerous, or is it simply the inevitable result of modern finance? At this point, it's tempting to blame BlackRock for everything. Its size, its influence, its connections with governments, its voting power, its technology. But that would be too easy. Because here's the uncomfortable truth. If BlackRock disappeared tomorrow, the system wouldn't. Another firm would eventually take its place. Maybe Vanguard, maybe Fidelity, maybe someone that doesn't even exist yet. Because BlackRock didn't invent the forces that made it powerful. It simply became the best at serving them. Think about it. People wanted cheaper investments, so ETFs exploded. Institutions wanted better risk management, so they adopted Aladdin. Governments wanted experts during financial crises, so they called BlackRock. Pension funds wanted steady long-term returns, so they entrusted trillions of dollars to firms like BlackRock. Every step made sense on its own, but together, they created something nobody had really planned. A financial system where an enormous amount of capital flows through a surprisingly small number of institutions. That's why economists sometimes refer to firms like BlackRock as part of the shadow banking system. Not because they're operating illegally, but because they perform many functions traditionally associated with banks while being regulated under a different framework. For critics, that concentration creates a new kind of systemic risk. If too much money is managed using similar models, similar strategies, and similar incentives, then a future crisis could spread faster than anyone expects. Supporters disagree. They argue that BlackRock is actually part of the solution, that its diversification, its risk management, and its long-term investment approach make markets more stable, not less. The truth is, nobody really knows. Because we've never seen a financial system where so much of the world's wealth has been concentrated under so few asset managers. And that's the real experiment we're all living through. If you enjoy understanding global chaos in slightly less chaotic ways, you know what to do. Now, let's keep going. BlackRock doesn't manufacture anything. It doesn't invent the next iPhone. It doesn't build rockets. Most people will never become BlackRock customers directly. And yet, its fingerprints are everywhere. In retirement accounts, in pension funds, in ETFs, in central bank mandates, in boardroom votes, even inside the software used by some of the world's biggest financial institutions. That's why the internet loves to portray BlackRock as the invisible hand controlling the world. The reality is both less dramatic and far more fascinating. BlackRock didn't conquer the global economy overnight. It earned trust, one client at a time, one crisis at a time, $1 trillion at a time, whether that's reassuring or deeply unsettling. Depends on how you look at modern finance. Because maybe the biggest story isn't that one company became so powerful. Maybe it's that our entire financial system naturally evolved in a way that made a company like BlackRock almost inevitable. And that leaves one final question. If the next financial crisis arrives tomorrow, will governments once again turn to BlackRock, or has the company become too important for the system itself?